Hi, I'm Christine Benz from Morningstar. Investors continue to favor international equity funds in 2015. Joining me to discuss the latest news in the world of fund flows is Tim Strauts. He's a senior markets research analyst with Morningstar. Tim, thank you so much for being here.
Thanks for having me.
So, Tim, you and the team have been monitoring these fund flows into international equity funds. We've seen them outperform U.S. so far in 2015, but this has actually been going on for a while where investors have been choosing foreign funds at the expense of U.S.
Yeah, the trend has been happening for about 2.5 years now, and it's only accelerated over the last year. In the last year, a little over $210 billion has flowed towards international funds. And in the U.S. equity space, we've actually seen an outflow of a little over $10 billion in that same time period. So investors are clearly preferring international right now.
And you think it has something to do with the fact that the investors in U.S. funds are sort of anticipating Fed tightening and thinking that the economic cycle in Europe in particular could be more favorable for foreign fund investors?
I think we're kind of a unique period here where typically fund flows follow performance, but that really hasn't happened here because U.S. Equities have actually been a better performer than international. But what's happening, I think, is that investors are very skittish about the U.S. bull market. They've never really fully bought in to the performance. They feel that in some cases maybe the Fed is manipulating things with the ultra low interest rates, and they really just haven't bought in. So investors have been allocating over the last several years to international because potentially the valuations look a little more attractive.
Okay. So when you look at the types of international equity funds that are getting the flows, where is the money going?
So it's focused on the index funds right now. The largest flowing fund is the Vanguard Total International Stock Fund. And we have seen in the past 2.5 years flows into emerging markets, ETFs being strong. That trend has actually switched recently, where now most of the flows are going to the developed international markets and away from emerging.
Okay. So you touched on the problems that we've been seeing with U.S. equity fund flows. The issue has really been concentrated in the active products. Investors are pulling their money there. Many are reallocating to passive products, but it hasn't really been able to make up the money coming out of active funds.
Yeah, in the last year, active U.S. equity has lost $158 billion, and passive U.S. equity has taken in a positive $140 billion. So they are almost balancing out, but they're still to the negative because of the large active outflows.
Okay. One complicating factor, and we probably don't want to get too far in the weeds on it, but Fidelity has been doing some repositioning within its lineup, especially for retirement plan investors, where it's swapping people out of the mutual funds or traditional mutual funds and putting the money into collective investment trusts that are managed in what, exactly the same way?
Yes, so collective investment trusts are used in 401k plans, and Fidelity's been doing a lot of it, but many other firms have been doing it also, and it's a way for them to potentially, a 401k provider, maybe get a little bit lower fees, but the same exact strategy. So Fidelity, they actually disclosed the amount of the conversions over the last year to us, and it actually makes Fidelity's numbers, changes them by about $14 billion. So it's a $14 billion difference in the flows. It makes U.S. equity flows look $14 billion worse. It makes Fidelity's flows look $14 billion worse. When really they haven't lost that money. They just moved it to a different vehicle.
Okay. Actually, Fidelity's equity fund performance, domestic equity, has been pretty good during this bull run.
Yeah, and so that's why for the last several months we've been kind of questioning some of the outflow numbers because we have been hearing rumors of the conversions, but we hadn't actually gotten the data like we got in this last month.
Okay. Also on the fund flow front, you look at fund flows by family. So Fidelity, you just touched on. Interesting turn of events recently. We had been seeing this gusher of outflows from American funds for a period of years, really. They appear to be back in asset gathering territory. Investors are sending money to American funds.
Yeah, in the last year, they took in over $10 billion in assets. Just last month, it was $1 billion. And it's been a slow and steady gain after many years of strong outflows. And what's interesting about this is that there hasn't been an event that you could say, oh, this is the reason the flows are coming in. Because American funds performance actually never really fell off that much on a category basis versus their peer group. So it just seems that all the financial advisors that got out of American funds, they're finally all gone, and now they can start building back up.
Okay. Another fund family story that I know you and the team have been monitoring has been the PIMCO story. Big ongoing redemptions from PIMCO Total Return, not fully offset by inflows into another PIMCO product.
Yeah, Total Return lost another $3 billion last month, and previously we were seeing the flow numbers get a little bit better for Total Return, but in the last 3 months it's been about $3 billion each month, so it's kind of leveled off. And $3 billion is still a substantial amount, so PIMCO definitely has things to be worried about. But they have been receiving flows into the PIMCO Income Fund, which is run by Dan Iveson, who is also now a co-portfolio manager on the Total Return Fund. Thing is, though, the Income Fund is not taking in as much money as Total Return is losing right now.
And I guess another thing that I've been watching with that PIMCO Income Fund is, do people understand how much more risky it is than some of the other core bond products?
Yeah, the PIMCO Income Fund is really not even directly comparable to Total Return. It has emerging market debt, it has a lot of non-agency mortgage securities, things that the Total Return Fund just really isn't going to buy.
Right, certainly has an attractive yield, which I suspect is part of the attraction. One fund family that jumped to the top of the asset gathering rankings this month, in the month of July, was a firm called Bridge Builder. Let's talk about that and what those funds are.
Yeah, we've been seeing it this month especially, but then for the last several months. And initially, I had no idea what Bridge Builder was, but after doing a little bit of research, it looks like it's actually an Edward Jones product for Edward Jones financial advisors in their advisory accounts. In the past, Edward Jones would have select lists of funds that were available in their advisory accounts. But now it looks like Edward Jones is converting over to moving all the money to these Bridge Builder funds. And now the Bridge Builder funds are actually then sub-advised by many of the same managers that were on these select lists. So it's a way for Edward Jones to kind of bring everything in-house. So we're seeing lots of conversions and large inflows into these products, but they're not actually new money. It's money just moving from the original mutual fund to now these sub-advised funds.
Okay, Tim, thank you so much for being here to share your insights.
Thanks for having me.
Thanks for watching. I'm Christine Benz for Morningstar.